Okay, we're live for the archives and back from lunch, and we're going to start just jumping into our next set of plays. So basically what we did on the first part of the seminar is we just kind of laid the foundation in terms of hardware, software, the type of markets, and most importantly, how to read the intraday indicators. If you know how to do the intraday indicators, that gives you a base for everything else in the markets, because basically it teaches you how to read the markets. It's almost like a musician reading music. That's what I've heard, at least from people who can read music, because I can't. But it just kind of, if you can understand the ebbs and flows of the markets and why it's happening, that's going to make you that much of a better trader. And how you do that is through the intraday indicators. So now that we have all that, now that we have the foundation done, we're going to jump into what I call, it's basically the first and most important play of the day, and it's gap plays. And we start off every trading day basically analyzing the gap, and the gap will also determine how we spend the rest of our days. And this is just, basically everything that we do, it starts with the intraday indicators, and then it starts with the gap, and then goes from there. So what we want to do is spend some time on the gap, and then we'll jump into our other setups. So what exactly is a gap? The gap is basically, it can get a little confusing, because if you're watching a 24-hour chart, you're not going to see any gaps. What a gap is that there's a differential in price from the 4:15 p.m. Eastern close to the 9:30 p.m. Eastern open. So you can see here where we close on this particular day on March 15th, and we open up here on March 16th, and this creates a gap in prices. And as you can see on this particular day, the markets came down and they filled the gap before going on to move and finish the day. And this is a very common occurrence in the trading day, and it's something that we want to pay attention to and take advantage of. Basically, you can think of the gap as being like an open window. Like any open window, at some point somebody's going to come along and close it. And on the daily charts, generally 70 to 80% of the time, these gaps are going to be filled within that same day. And so that's really important, because first of all, the gap is a high probability setup. Secondly, we're going to show you some tools that can give you an edge when playing gaps. And third, we also look at some tools to show when the gaps are most likely not to fill and how to take advantage of that as well. And so all of these kind of put edges in our favor, making the gap the highest probability trade that we do. Basically what I like, my favorite gaps are, like right now the market's been in a downtrend for the last 6 weeks or so. So my favorite gaps right now are gap ups. A gap up is in the opposite direction of the prevailing trend, and the gap ups are going to have a slightly better advantage of filling than a gap down. I also like gaps in the Dow at least over 20 points, because that at least kind of gives you something to work with. But that's something we're going to talk a little bit more about later. So one of the questions is, when playing gaps, why focus on indexes and not stocks? And the whole key with gaps is that you want to focus on multifaceted indexes as opposed to like single unit indexes. What does that mean? Roger K has a question. The YM closes at 5 p.m. Do I still use a 4:15 close? Yeah, you basically want to look at the 4:15 close, because that's when the S&P closes, that's when the NASDAQ closes. So you want to get that reading on the Dow at 4:15. When you've got a single market like the bonds, or the euro, or even like a single stock, those gaps do not fill as consistently, because what will happen is if a piece of news affects that market, if you've got a news that affects the bond market, or if you've got a news that's affecting a single stock, like say Enron, those gaps can have a very low probability chance of filling, because they're news-driven gaps. What happens is when you get something like an index, the indexes are made up of a bunch of different components. So if you get some news or something that makes the indexes gap higher, so let's say the Dow gaps up 40 points, well, that doesn't mean that every Dow stock is going to gap up 40 points. Some stocks are going to be negatively affected by any news. So the Dow will open, and the fact that some of those Dow stocks are going to fill their gap, and some of those Dow stocks are already negative, basically sets up the entire index to fill its gap. And what happens, this happens so routinely that many hedge fund managers and many of the guys managing retirement accounts and things like that and pension funds, they actually will not commit to setting up new trades intraday until a gap's filled, because they know that the probability of that happening is so high. So it becomes kind of a self-fulfilling prophecy that way. Now, the one way you can do this if you're a stock player, the one way you can play stocks and play gaps is that if you get a stock that's gapping up in proportion to the market on no news. So let's say that the S&Ps are gapping up 5 points and KLAC is gapping up 50 cents on no news. Well, that market is moving that stock is moving with the market, and that's a playable gap on that particular stock. I personally really don't mess around with that. The gaps in the futures indexes on the Dow and the S&P work just fine, and they're very consistent. I don't use gaps in the Russell, and I don't play gaps in the NASDAQ. They actually do fill almost as frequently, but there's going to be some days where there's news just on small cap stocks, or there's news just on technology stocks that's going to skew those particular indexes. I've just found that the Dow and the S&P, they're more broadly based, and they have a better chance of filling, so I just focus on those for the gaps. I already actually talked about this, why indexes get filled. We just talked about this, how all the different components of an index are reacting differently to news, so that basically can pull an index down or raise an index higher so that it actually ends up getting filled. So here's an example of a gap. You can see, based on here, on July 23rd, and this is, I think, 2003. We've got some more recent gap examples, too. And by the way, these gaps happen every week. We'll show you what determines why we would play one or not. On this particular example, we've got a gap on July 23rd. So you can see the closing price here at 91.69. And then the next day, and this is the 4:15 close, and then at 9:30 the next day, we open at 92.33. Okay, so that's a gap of 64 points. Well, what happens during this trading day then is the market, on this particular trade, what we're doing is fading the gap. So we're shorting at the open. We come down. We get close to the gap fill, but we don't fill. We get some economic numbers that push the markets higher. And then we spend the rest of the day just kind of treading water and fading. And then finally, towards the end of the day, we just collapse and we fill the gap. And this happens 70 to 80% of the time. And so it's important to be aware, where the gaps are located. And so we'll set up our first play of the day based on where the gap is and its chances of getting filled. And you can see here there was a small gap here that filled very quickly the very next day. So that's just an example of one gap. We'll go through some more, because one of the things I want to talk about too is parameters. On this particular gap here, you can see the same thing. The market's gapped up, and then even though some economic news shot the markets higher, what happens? The markets eventually roll over and fill their gap. Okay? And again, this happens 75 to 80% of the time. And then with some of the stuff that we look at with pre-market volume and things like that, we can actually increase that edge to about 90% of the time. Another example here, and this is more of a common, this is kind of more of an average or common gap that we would see, is you start off with a modest, almost 4-point gap. You can see here we close here. That's the 4:15 close on the S&Ps. We open up the next day, 4.5 points higher. We push a little bit higher, but not too bad. We come down, push a little bit higher, not too bad, and then we fill the gap. What happens is that we get the opportunity to see a lot of traders try to handle something like this, and what will happen is most traders, they'll sit here and so they'll short the gap up, right around here on this level. They'll short the gap up, and then the market starts moving down, and so then they bring their stop down to break even, and then what happens is the market comes back up, they get stopped out, and they don't make any money. How we play the gaps is we set it up to take advantage of these movements so we can actually make money when the market's gyrating back and forth like that, and we get our gap fill. Because the whole purpose of it is to be patient and wait for the gap fill. Just another example of gaps. Somebody had asked me once, well, what about if it's Fed day? Or, what if something else is happening like that? The gaps are the gaps, and they will happen regardless. You can see on this particular day, there was a Fed day. We gapped up huge, 65 points. And what do the markets do? They just kind of spend all day chopping around. We fall, we rally, and then the numbers come out. We come down, we fill the gap, and then we shoot higher into the close. But, look where the lows were on this particular day. The lows were exactly where the gap was. So it just goes to show you how important these are and how how conscious the market is and other traders are of these gaps, before committing to moving the market higher or lower, trying to go back and clean up those gaps. All right? By the way, the previous chart, it showed something of a live gap example. We will actually be including that in the archives. It's just going to show you a couple of live examples that you can see and how they work. So now the question is, if 75 to 80% of the time the gap plays that we do are filling, what happens when they don't fill? What happens is that these are called pro gaps, and we've actually got some ways to determine whether or not we're going to get a pro gap before the market even opens, and that's part of what we'll be covering with you. Basically what a pro gap is, it's designed to move the markets in a way to keep as many people out as possible. So it's one of those things when you wake up in the morning and the Dow is gapping up 100 points. Well, it's basically keeping everybody out of the move, because what will happen is now it's going to be too high to buy. People will just sit back and watch it, and the market's just going to basically move without them. And what will happen on those, what I like to do is on days when the gap doesn't fill, I always write down that price. So if the opening gap was 93.84 and the gap doesn't fill that day, I'll put that number on a post-it note and stick it on my computer. And I'll always have that in mind as an open gap, because what's going to happen is when you have an open gap within 5 to 10 trading days, that open gap has an 80% chance of filling. And that's really good for when you're setting up trades later in the day. And these open gaps, they're kind of like black holes, and they just sit there and it's almost like a gravitational pull on the market, on the price action, and they're great for setting up targets later in the trading day or later in the trading week. So let's look at an example here. All right? On this particular chart, you're going to see, this is kind of a nice example because not only does it show a gap that didn't fill, and by the way, on this particular morning, we did not take this gap play because of what we call the pre-market volume. Yeah, if you're asking about, Scott, you're asking about a 20-point gap in the Dow, well, what about the S&P? Remember that 20 Dow points is like 2 S&P points. So that's like a 2 to 8 point gap in the S&Ps. So like you can see on this particular day, we've got a gap that didn't fill. So what you got to remember is what I'll do, and especially you can do this on your chart, just draw a line across your chart for future price action, because this is going to be a target for future price action. So what happens here is you can see now not only do we have an open gap that's sitting there below us, oh wait, there's a question here. That's actually a good question. Do hedge fund managers not also play gaps? Roger, the thing about gaps is they're an advantage for the small investor, because hedge funds and pension funds, they're moving too much volume to do stuff like play gaps. If you're coming in there and trying to sell 5,000 S&Ps and you're managing a $17 billion pension fund or a $10 billion hedge fund, you can't. The market's not going to be able to soak up that much volume. So this is something that's specifically designed for the intraday trader that's trading a small account. And by small account, I mean, if you're trading less than a couple $1 million, this is something that is basically designed for that type of a trader, because they're going to have the flexibility and the maneuverability to get in and out of gap trades like this. So on this particular chart, so you can see we got the open gap here, and then we didn't fill. So what I want to do on something like this is I'm going to just draw my line across, and that's going to be a target for future stock movement. You can see on the next day now, what will happen too is you're going to get gaps throughout this that you can play. Now this gap was 13 points right here, so I personally did not play it because I want to see at least 20 points to make it a good risk-reward ratio. Now this next day you can see the markets closed here, and they opened down here. All right, that falls into my parameters of greater than 20 points. So I'm a buyer here at the open. My great arrows. And then you can see that this was actually a pretty painless gap. I call it a Bahamas gap because basically as soon as you get into the trade, there's really no stress, and then it just goes to fill the gap almost right away. Then the next day, we get a gap of 44 points. You can see we close here. We open up here. Almost get stopped out, and I'll talk about your parameters in a moment. But then we turn around and come back and fill the gap. So that's a 44-point play. And then we get this great play the next day where it's a low volume gap up. You can see we close here. We open up here. Gap up of 62 points. We're shorting. There's no stress. The market doesn't even try to rally. And it basically just falls like a rock very quickly. Okay? So now what happens then is once this market fills its gap, it actually pushes lower and starts consolidating, making a bear flag right here. Now what happens, those of you guys that know consolidation patterns, when you get a market that moves a specific way up or down, moves for an amount of time and then starts consolidating, all that is the pause that refreshes. This is just called a continuation pattern. The markets are just stopping to catch their breath before they continue to move. So when I see something like this, I'll just put a sell stop below that level. So when it breaks it, if and when it breaks it, I get short. Now, what's my target? Okay, I've got a great clean target right here because there's an open gap that needs to be filled down at this level. So basically, you can just kind of, you put a basic money management stop up above simple resistance, and you just stay in the trade with your target as the next gap fill. So on this particular trade, on this particular day, we netted 62 points on the gap play, and then another 95 points on this play when the market broke down and went to fill its gap. So that's the importance of knowing where the open gaps are in the market, because you can use them as targets for future moves, and those will generally hit those targets within 5 to 10 trading days. Okay, here's another example here of another breakaway gap, and here we had a 61-point gap. You can see we close here, we open here, and it's a breakaway gap. The market just kind of continues to rally and do its thing, and then on one day it just rolls over, gets killed, comes down, touches the gap almost exactly, okay, right there, before rallying on to new highs. So again, the markets they like to clean up their gaps, they like to go back and shut those windows. So anytime we have open gaps in the market, I always like to be careful and acknowledge where they are, because I know at some point within the next 5 to 10 days, the market has an 80% chance of coming back and filling those gaps. All right. So what are some of the key methods here for the gap? What we want to do is we watch pre-market volume in a set of key stocks to get an idea of the power behind the move. And my four favorites that I like to watch, even though these are not Dow stocks, I like to watch KLAC, Maxim, Novellus, and Applied Material. You can see these four right here. And what I do is around 9:25 Eastern, I will check before the market's open. I'm going to check these stocks and see how much volume has traded pre-market. If these stocks have traded less than 30,000 shares each, okay, the gap has a 90% chance of filling. Now, why is that? That means that the markets are just probing, especially the market makers and the guys in the pits. When the markets open up, say, 4 S&P points or 40 Dow points, and there's no pre-market volume in the cash market, i.e. the stock market, that means all you've got are people in the pits that are just probing stop levels. There's no power behind the move. You can picture like a car going up a hill, and it's on E in terms of gas. It's just, it's not going to have a good chance of making it up that hill. It's going to run out of gas and end up rolling all the way back down. So in these particular instances, you've got a market where there's no volume behind the move like that, which is pretty important. Okay, Roger K is asking, where do I find the pre-market volume for these stocks? Roger, what platform do you have? What do you use for quotes? Okay, I'll show you on Monday how to set it up then, because I'll show you. It's basically, if you put it in a radar screen and just put up a volume column, it's going to show you the pre-market volume, because it starts tracking the volume at 8 o'clock in the morning Eastern. Malcolm, okay, I'm trying to read and understand your question.
Yeah, I'm talking to the...
Fill the gap lower.
Oh, it's a half a gap fill, is what he's asking.
Okay, yeah.
Then we'll be going over it.
Yeah, well, Malcolm. Yeah, we'll go over that in a second. There's a high trade probability for 50% gap fills, which we'll be going over shortly. All right. So now the other thing is that. So if you've got these stocks trading 30,000 shares each, okay, that's light volume, you got a 90% chance of going. Now, if they're trading over 80,000 shares, basically that means you've got pre-market, that means you've got high pre-market volume. Malcolm, I've never seen that happen. That's a good question. I've just never seen that happen. The question is what if you get a gap down, but then those four stocks are trading higher? I think I may that happen once, like on a semiconductor upgrade, but. Oh, okay. Yeah, Malcolm, just check the news on that stock. If that stock has news, you just ignore it. What you're looking for the stock market volume on stocks that don't have any news. And also, those are the four key stocks I watch, but I also watch, if you go to onechicago.com, which is this, Chicago, that website lists the 95 or so stocks that they list as single stock futures, and these are all the stocks like Microsoft, Intel, all the big stocks like that, and KLAC, Maxim, Novelis, and all those. I actually watch all 95 of those. I don't watch the single stock futures. I just watch the underlying cash stock, but I just want to know pre-market what all these stocks are doing. Is there a lot of volume coming into these or not? And so that's one of the things we'll do on Monday, is I'll actually show you how this works pre-market, and we'll look at that live. It's a pretty important concept, but it's easier to explain when it's really happening, so that's one of the things that we're going to look at Monday morning. The main thing is that you want to see if there's low volume coming into the cash market before the open or high volume. And those four stocks that I'm talking about are an easy gauge to see if it's low volume or high volume. So now if you talk about those about being a 90% chance of filling when there's low volume, now if you've got these stocks trading over 80,000 shares, now you've got the high probability of a pro gap. So that means on these days, we're not actually going to fade the gap, and we'll in fact be buying it. Most of the time, like, Hubert, what do you think? Like, pro gaps happen about, 1 out of every 20 gaps? Maybe less than that. Maybe like 1 out of every 30.
I don't know. I think I don't know. Pro gaps, they do happen. You just have to... And a pro gap is just when it gaps up and it goes and it cruises to new highs and it doesn't fill the gap in that day. Pro gaps do happen. I'm more of an intraday scalper, so I'll throw a 10-point stop on there. Percent-wise, I don't know. I could probably do a raw gap or raw pro gap one and calculate it out of how many days. That'd be a good study. That's probably more, 2 or 3 times out of 20 at the most, and the worst case scenario it'd be 1 out of 30. It all depends. Like in the summertime, it's a little bit more choppier. And does a gap from form? There's a lot of different reasons why. I mean, the best thing I can tell you is do not ever try to figure out why it's happening. Don't try to figure out why the gap's happening. It's just happening. And you want to play the raw gap data and just the numbers. It's a pure numbers game. The same exact thing when people are trading futures. They'll be like, "Oh God, the market just fell apart 50 points. Why?" If you try to figure out why, you're sitting there trying to figure out why when you should be actually on the side of the market as it's tanking. Don't get caught up in the news stuff. The news stuff, people that trade news as a whole, if they're not privy to the news before it comes out, lose money just because they're always chasing the cat's tail, okay? You just want to react to the ebb and flows of the market in the direction, and you can figure out why it happened after you cash your account out and ring the register.
Bradley, what you want to do on that is those 4 stocks are the key ones, but you also want to look at all those stocks that are listed on One Chicago, because what's going to happen on a day like that is you're going to have like an upgrade or a downgrade on Applied Materials. So then you're basically going to take that stock out of the loop. You want to see what's happening to stocks that aren't getting hit on any news. Okay, if a stock has news, so what'll happen, like some days you'll hear us talking about the pre-market volume, and we'll be sitting there going, okay, we've got low pre-market volume, except like, Yahoo's trading 600,000 shares. Well, maybe Yahoo is upgraded, or maybe Yahoo had earnings. So we just discount that stock. We want to see what's normal cash flowing into normal stocks without any news on them. So that's the whole key there. So now what'll happen? Now here's this. Now this is not written down on here. So this is not in the manual, but this is what you want to write down. Is that if we got a day where we've got 30,000 shares, okay, or less, that's when we use our full gap strategy, which we're going to show you the parameters here in a second. But if we've got a day where we've got between 30K and 80K, if I can write this out here. It's hard to write with a mouse. On those particular days, we have a different strategy that we use. And what we do is that we'll still short a gap up, or we'll buy a gap down. But on days when you've got what I call moderate volume, when we get to the halfway point, the 50% retracement level of the gap, we take half off. So instead of trying to hold for the entire gap, we'll take half. We'll take half off at the 50% level. Does everybody understand what that means? So basically, if you get a 40-point gap, then the market, say the Dow gaps up 40 points, and then it falls 20, halfway, we're taking half our profits there. And then we'll just basically hold the rest with the target as a gap fill. All right? That's really important because this is something that we've been tweaking with a long time, and we've actually improved our odds by doing that. Yes, that's actually a really good question, Sarah. What we do then, and we'll go over this on Monday too with the live trading, is that on a moderate day, instead of using a full size, all right, we're going to use 2/3 size. Boy, I cannot write with a mouse. I guess I could type this in HotCom, huh? Yeah. So, here, I'm going to type these out real quick, too. Okay, so if we got low volume, I'm going to type all these out. Low volume, which is less than 30K, then full size for full gap fill. All right. If we've got moderate volume between 30K and 80K, then it's 2/3 size with 1/3, with half of that off at 50%, and then 1/2 off at the gap fill. And on the days when you're doing 2/3 size, when the first half is hit, move stop to break even. Okay? That's all important because it's not in this manual, so you need to make sure that you write it down. Now, on the last part, what you want to do is when you get something that's over 80,000 shares, okay? If it's over 80,000 shares, we're not going to take a gap fade play. In fact, we're just going to completely ignore it because that has a really good chance of becoming one of those gaps that doesn't fill. All right? So the last piece of this puzzle is if you have high volume of over 80K, no gap play. All right, so those are the trading rules for the gap plays. Or let me say no fading gap play. What will happen on those days, if we get a gap up of over 80,000 shares, we're going to actually be looking to focus on the long side, and we're going to take scalper buys and squeeze plays. But that's something that we're going to talk about later. But we're not going to be fading that. Yeah, so Justin, basically on days, so yeah, perfect. On days when you get over 80,000 shares, you're looking for a runaway gap. So instead of trying to fade it, we're looking for our first buy signal, and we're going to take the first buy signal of the day. That could be a pivot play, it could be a scalper buy, it could be a tick buy, it could be a fib buy, it could be a squeeze buy, and those are all plays that we're going to review later through this tutorial and through this manual. Okay? Does anybody have any questions on that? Because some of that stuff is not in this manual, and that's all critical to playing the gap. Sarah, no, that could be either way. You can have an 80K gap to the upside or an 80K gap to the downside. The direction doesn't matter. It's just the volume. The volume is what's critical. In fact, this week, or last week, what is today? On Wednesday, we had a breakaway gap to the, or whatever day it was, we had a breakaway gap to the downside. We had 80K volume, so we didn't fade it, and in fact, we took the first sell signal and made some decent money on that. Right, so if you're over 80K and you're gapping down, then you're going to take your first sell signal. If you're over 80K and you're gapping up, you're going to take your first buy signal. All right, you guys understand that? There's going to be 3 different situations for gaps and 3 different ways to play it. Okay, cool. So now all those charts I showed you guys before, those were all basically the 30K gaps. Okay, that's the whole essence of the gap play, is that you're shorting the gap. You know, if you got a gap up less than 30K, you're shorting it, and you're basically waiting for the gap fill. And then on that same play, if you get 30 to 80K, you're basically going to take half off at the 50% level and then move your stop to break even. And on that same gap, if it was over 80K, you're just not even going to play it, and in fact, you're going to go with it. Okay? It's real critical, and what's important here is that you've got different methodologies for playing the gaps under different circumstances. And it's really important because what will happen is if you get and obviously the most important thing here is if you know that there's a gap up and there's high pre-market volume, you know that this is going to be a good chance of being even if you don't play gaps at all, you'll know that you just want to focus on the long side this day because you've got real money coming into the market. All right? The other thing I want to look at here, and then pretty soon, in a few minutes, we're going to jump into raw DAPGATA. But the other thing I want to show you guys here is what I call, you remember when we were looking at the sector sorter list for the intraday stuff? This is something I'll look at too. If you've got a gap down, or say you've got a gap up, and you've got low pre-market volume or moderate pre-market volume, okay, so the market gaps up, right? Well, here you've still got like 6 sectors that are red. So even though the market is gapping higher, you can already see that there is selling in the market. Okay, this is a good sign. So if you've got a gap up and you've already got some sectors that are red, that's a good thing. And so what you want to see is that you just want to see, more sectors go red as the gap wears on. So I just use the sector sorter list to measure the intensity of the gap as well. Roger, right. So if you've got a high pre-market volume gap, you're basically, if you gap up and you've got high pre-market volume, you're looking to buy. If you gap down, you've got high pre-market volume, you're looking to short. that is the exception to the rule, because 9 times out of 10, it's either going to be a low pre-market volume or it's going to be moderate pre-market volume. It's rare when you get those over 80K gaps. So most of the time, if you're not really sure, it's probably moderate. Is there a way you can chart the sorter list on a bar chart for visualization? Yeah, I mean, you mean put each one? You mean put each one of those stocks into its own chart?
Is he talking about like a bar chart for Excel?
I'm not sure. We don't understand your question. For together. Oh, okay. So you mean just put them all on one chart so you can watch them visually? Yeah, you can do that. Yeah, for me, what I do is I just like to look and see basically how I use it. I just like to sit there and go, okay, what percentage of the sectors are green and what percentages are red? Because I know if we've got a day like this, and it's the same thing, we were talking about the trend and the trend queue. If the trend, it's not so important that the trend's 1, it's where it was when it started the day. So it's not so important on the sector sorter list that we're 80% green and 20% red. What's important is what this is right now compared to where we started the day. So if at 10 o'clock we were like 100% green, and now at 11 o'clock we're only 80% green, I mean, I can see that the selling pressure is kicking into the markets. So that's kind of how I use that. Okay? So, that's just what I talked about on the sector list. So this is what we do. Okay, now there's another piece of the puzzle I'm going to add in here that's not on here, so I want you guys to write this down. Sarah, there are gaps probably
3 out of 5 days.
Yeah, 3 out of 5 days. I mean, gaps generally happen almost every day.
Today we had 4. This week we had 4 out of 5.
Yeah. Now some gaps aren't playable because if the S&Ps are only gapping up like 1 point, or the Dow's only gapping up like 10 points. Generally, I'm probably not going to take it because I like a little more room in there. But gaps generally happen, playable gaps, 3 to 4 times a week, which is why we stare at these every single day as kind of like the first trade of the day. All right, so I'm going to add some stuff in here on this slide that I want you guys to write in. All right, this trading methodology I'm telling you at first is how I kick off the low volume gaps and then the moderate gaps, but I've got one specific change on here, okay? And the change is this. If the gap is less than 40 Dow points or 4 ES points, I use a 1 1/2 to 1 risk-reward ratio. Okay? However, if the gap is more than 40 Dow points or 4 ES points, I use a 1 to 1 risk-reward ratio. All right? So what does that mean? If we gap down 30 points, I'm going to use a 45-point stop. That's 1.5 to 1. If we gap down 45 points, I'm using a 45-point stop because that's 1 to 1. The reason I use wide stops on these gap plays is that by using the wider stops, you've got an 85 to 90% chance of winning on that trade. So even though your risk reward is greater, the number of times that you're going to win is also much greater. If you're using real tight stops, you're going to get stopped out of these trades more often than not. So that's a little trickier. The other thing that's important to realize this on this too is that if you've got say the moderate volume, the moderate pre-market volume, you gap up 50 points. So you start off with a 50-point stop. Well, as soon as you get your 50% gap fill at 25 points, you're bringing your stop all the way to break even. That 50% gap fill happens with a very high frequency. So when that happens, you're actually reducing your risk significantly by moving your stop on the rest of your position to break even. So it's actually very rare that you get stopped out on these gaps, especially with the moderate volume like that. You'll at least get out a half, and so all of a sudden you cut your exposure and you cut your risk down to zero because you've got a free position on. Because if you get stopped out on the second half, you basically have a break-even play. You lose 25 points on the stop, but you made 25 points on the gain, so it's a break-even play. All right? Does anybody have any questions on that? All right, let's see what we got here now. All right, before we jump into this, Hubert's got a section here of raw gap data that we're going to jump to, and this is on page 277. So if you guys want to go to page 277 in your manuals, Hubert's going to go over the raw gap data. All right, so I will turn it over to Mr. Centers.
All right, let's get started here. This is raw gap data that I've done in the S&P. I've also have it for the Dow. It's not in the manual, but just email us and I'll send you the raw gap data for the Dow Minis too. Okay, so let's just go along here and follow it word for word. It's some good stuff, and it's actually the statistics behind why gaps fill and stuff. The study was done with S&P E-mini contract traded electronically. It's at ES. The data is from January the 15th, 2002 to the 20th of February 2004. So it's only 2 years, but it's enough data to actually make it work. Okay. What's the probability of a gap fill total, and which day of the week is the gap fill more likely? On average, all gaps fill, regardless of news and everything. This is me just going back 2 years of data and crunching. They fill 76% of the time on the ES. Now, what you can do, it works almost. The numbers are almost identical to the Dow too. There are a couple variances, and I can email you guys so that you can add to your manuals. Just email me at hubert@tradethemarkets.com or email service@tradethemarkets.com. So now, as you can see, Monday is the worst day for gaps, 65% of the time. What is the best day that you need to be playing gaps? The best day to play gaps by far is Thursday. 82% of the time they fill. So just knowing how often gaps fill as a whole is 76% of the time. Now you've upped your chances to 82 by trading gaps on Thursday. The days that I don't personally like to trade, I don't like Mondays, and I do not like Fridays. By Fridays, I'm worn out. It still has a high percentage. It's just usually it's choppy. It may fill, but if it fills the gap on Friday, it'll do a lot of this stuff before it fills it, okay? So by far, the best day to play gaps are Thursday, okay? Now, let's go to the next slide. And Wednesday, the best days to trade them are Tuesday, Wednesday, and Thursday. Let's go to the next slide. All right, now, what size gaps are most likely to close? This is on the ES data. 1 point on the ES fills 93% of the time. 2 points fills 90% of the time. 3 points fills 82% of the time. 4 points fills 86% of the time. Let me get my pencil here. 86% of the time. 5 points is 60% of the time. 6 points, 77. 7 points, 71%. After you hit about 7 points on the ES, and that equates to about 70 points in the Dow, it drops off. Look, it drops from 71 to 54. And then it drops all the way to 54 until 12 points, which these are just anomalies. The weird things that you need to throw out in the data, it's just because 22-point gap fill, I think it 100%. It happened one time. It was just a weird one, and you need to throw this one out too. It's just an anomaly in the data. Okay, it did fill, but I think there was only one gap and it filled, so you can't really just factor in one gap. So does that make sense to you guys? So now, if you're just playing pure gap data and you know nothing else, there's a gap up on the Dow Minis on a Thursday and it's 20 points. What are you doing? No, I just round. Okay, guys, so if you've got a gap up on Thursday and it's 20 points, what are you doing? I mean, my sides, no. Do not up your size. Keep it the same size. You just know you're going short and you're fading the gap. The reason you're fading it is because 20 points on the Dow is this number here. 2 points on the ES. It's a 90% play. Okay, and then we're going to go back one. Let's go back one. Thursday we know is an 82% chance, right? And then we have a 90% chance on the point wise. I have these posted right next to my screen. So I don't have, and I've actually got them memorized. Like, I know that, 5 points is 60%, 4 points is 86. I also have them posted right onto my flat panels while I'm trading, okay? So I know as soon as the gap up Monday, 65%. Really, that doesn't really thrill me, but, it's 65%. Now, if I get a gap up, let's say on Monday, and it gaps up 100 points on the Dow on Monday, what are you going to do? Monday and 100 points on the Dow, what should you do? Exactly. Sit there, ignore it, or pass. Correct. Because the percentages tell you to do nothing. If the percentages are not in your favor, why would you do it? Okay? So does everybody understand these two slides I went over so far? Anybody got any questions on them? Okay, alright. Let's go to the next slide. Alright. Is a gap fill more likely on a options expiration Friday? Alright, now, these are just yes and no questions. All Fridays fill 78% of the time. OEX Friday, your percents drop 76% of the time. Answer is no. Here's what you should do as a professional trader, and trust me on this. On options expiration day, do not trade. Go do something else. Golf, boat, anything. Go play with your kids. Just get away from options expiration day. Unless you have a lot of experience and some trading skills, you don't need to be trading on options expiration day. On options expiration day, you'll open up, you'll have an exaggerated move down, and you'll have an exaggerated move up, and you will finish about dead even almost all the time. Now, it may reverse it. It may open up here. Let's say this is the open point. It may explode and then get thrashed, and then it'll rally back and it'll close about even where it opened up. So just pass. Take my advice and pass on options expiration day. Plus, on the gaps, you're already lowering your percent down to 76, and it was 78. So you know it's a crappy day. All right. Anybody got any questions on this one? Is a gap fill more likely on a Monday following an options expiration Friday? Okay, look how much it drops. The Monday following an option expiration Friday drops from 65 to 62. I mean 52. Sorry, from 65 to 52, more than 10%. Do not trade it. Do not trade it. Is a gap fill more likely on a rollover day? All Thursdays are 82%. Rollover Thursday is 75%. Answer is no, but it's still high. But you could play it depending on if it's in your plan. I'm thinking long weekend, right? Exactly. So a couple that you want to pass on is options expiration day, the Monday after options expiration day, and then here's a judgment call just based on, pretty much your trading plan that you end up developing on your own. 75% of the gap fill is still high, but I would much rather just keep it to normal Fridays of 82. Is a gap fill more likely on a Friday after a rollover Thursday? Look how much it drops. It drops from 78 to 63. No, pass. This is the type of stuff that you have got to calculate. If you're going to be a professional trader and you're going to do this for a living, you have got to know how the markets work. What does the raw data tell you? Okay? And you don't need to know why, the reason why, the rhyme or reason. You just have to know what the numbers say. Oh, I skipped one. Hold on. What is the probability of a gap closing on the first or the last trading day of the month? Without looking at it, what do you guys think? You think the first session of the month is going to be a higher gap fill, or the last day session? And I need to change that. I need to. What do we need to do for the next one? Is I need to have it percent after. Yeah. All right. So the first session of the month, the first trading day of the month, you have a 56% chance of a gap fill. Last session of the month, your odds increase dramatically, 84%. Okay. This is all really good information that you will not know unless you go back and calculate it all. Is it better to be, let's fill the question here. Is it better to be in a new contract the week before it rolls over? What about last session of a quarter? I haven't done that one. What about the last session of the quarter? That's a new one. I'll add that. Is it better to be in the new contract the week before it rolls over? Yeah, there's an easy way to do that. What you can do is put your quote screen up, quote the old contract and the new one. Whenever the new one starts taking more volume than the old one, just roll over to it. That's all you got to do. Window dressing and all. I don't know. I'll have to do the raw data on it and see what the statistics tell me. All right. Are large gaps worth fading, or are they just too risky? Gaps over 15 points fill less than 40%. Okay? So we just pass on. All right. If you use a stop of, say, half a point on the ES, you have a 0% chance of making any money on the gap fill. The reason why is your stop is entirely too tight. There are going to be some price movements. There's going to be some gyrations. You have to be willing to have a stop a little farther than half a point on the ES, and that equates to like 5 points on the Dow Mini. Okay. Now, if you increase your stop to 5.5, and that's like 50 points on the Dow, you would have made 50-point profit just with the raw gap data, and that's not even taking in account the pro gaps that you'll learn how to pass on, and then passing on the Monday gap fades that really don't work that well. Okay, so all this is teaching you is you have to use a stop, but do not use a stop that keeps you so close to the market. So as soon as it moves, you get stopped out, and then it goes fills the gap. Okay. All right. You can also use a 25% stop loss. You would have netted 54 points. So this is a percent stop. If you use a 25% points of the gap from, let's say it gaps at 10,000 and it gaps up to 10,050, you take 25% of that move and use that as your stop. Okay? Then what you would have netted just on this raw data, it would have been 54.5 points. Okay? What is the probability of the gap filling if the gap is larger than the previous day's range? It's 35%. Okay? What is the probability? Does everybody understand that? What's the probability of the gap filling if the gap is larger than the previous day's range? So let's say yesterday we were in a 20-point range and we gapped up 40 points. Today, 35% chance it's going to fill. So you pass. Okay? Percent stop is just say there's a 40-point gap. You go 40 points times 25%. Whatever number that kicks out to you, that will be your stop. Okay? What is the probability of an extreme gap filling? It's 67%. A gap where the opening price is outside the previous high or low. Okay? So now this statistic is different from what's the probability of a gap filling when it's larger than the previous day's range. It's if it takes out the low or the high, it's got a 67% chance of filling. Alright, here's my favorite trade. I love doing this trade. What is the probability of half of the gap getting filled? It's 80%. Okay? Let's say the market closed yesterday at 10,000 it's at 10,040, and it's on a Thursday. Where do you think I'm going to be out of 3/4 of my position as soon as it fills half the gap fill? At least half of my position is going to be gone, and it's usually going to be 3/4. You guys understand that? So gaps fill on average 76% of the time. They fill half their gap fills 80% of the time. So if you get a 40-point gap on a Thursday on the Dow Minis, pretty much you're going for the first 20 points, and you're going to exit half, in most cases 3/4 of the position, then just manage the last quarter. Okay? Does everybody understand that? Okay. All right. Gaps and pivots, support and resistance levels. Now, John's going to go over pivots and stuff as soon as I get done. He's going to go over moving averages and then pivots. So this will come in handy right here. Price opens at certain levels, total percent closed. Let's say you get a gap up and it's above R3, okay? And we've got an indicator that works with TradeStation that actually calculates where the pivot is, where R1 is, where R3 is, where S1 is, where S2 is, and where S3 are, okay? So what I've done is I've calculated the raw data. If the gap opens up today and it's over R3, it's 100% gap fill, okay? You kind of got to throw that out because it only happens a few times, but it is still 100%. If the gap from yesterday's close opens up from R2 to R3, it's a 33%, okay? The ones that are the most important that you need to look at on these statistics are right here. Let me show you right here. This one right here. If it gaps up to the pivot or R1, it's 82%, okay? Or if it goes to S1 or the pivot, okay? So let's say we gap down to S1, okay? It's a high percentage play. Or let's say we gap up to R1. It's a high percentage fade too. Okay? These all calculate into how you play gaps. R1 and R2 is not bad either. But after R2, it drops off dramatically. Alright? Does everybody understand this? Does anybody have any questions? Okay. Does anybody have any questions on gaps, on pivots, support and resistance levels? This is boring stuff, but it's the statistics. Alright. You can go over this one on your own. It's pretty self-explanatory. Now we're going to let John go over, what are we going over, John? Moving averages?
Yeah, we'll do the moving averages in your ping pong play.
Okay, alright, cool. Alright, so we're going to put this on pause.
Yeah, I mean, just a couple things about the gap, and then I'll put it on pause.
Okay. Introducing John.
Okay, so that was everything on gaps. What we're going to do next is we'll go into moving averages, but I just want to summarize real quick on gaps. As you can see now, the reasons behind it, I mean, there's a lot of reasons to pay attention to gaps. Not only can you make money on them, but they're also going to determine the price action of the day. So, like I said, the first thing that we're looking at every day is the gap and how it reacts to the market and how the market reacts to the gap. And that'll set the whole tone for the rest of the day. So in the room, like in the trading room on Monday, that's the first thing we're going to be looking at. We're going to be talking about pre-market volume, and then we're going to be talking about the gap. And that gap, it'll be our first play of the day, and then it's going to determine our plays for the rest of the day, okay? So it's very, very important. It's important that you understand how it works. And what we're going to do now is we're just going to pause for just a few minutes while we save this file for the archive and then queue up the next one, all right? So I'm going to pause this now, and we'll be back online here in about 2 minutes.